You know when you imagine having money coming into your account without having to work all the time? It's like magic, but it's real. Today I'm going to tell you a story about an ordinary person who started learning how to invest in a smart way. Over time, she managed to save $1 million, and all of this thanks to the passive income that came from dividends, which are like small cash gifts that companies give you just for owning a part of them. And the best part, this path is open to anyone who wants to learn. You'll see that it's not difficult and that you can start now, even with little money. Are you ready to discover how to build your passive income and change your life? Then come with me. Step 1. From $0 to $20,000. The beginning of the journey. You know that moment when you look at your bank account and all you have is a few bucks? That's how Tom started. No inheritance, no luck. Just him, his salary and a dream. Get rich with intelligence, not magic. He had a regular job, like many people. He earned enough to pay the bills and eat out on the weekends. But one day, on a random trip to the library, because yes, he was one of those people who liked books, he found one that would change everything. The Richest Man in Babylon. This book taught something so simple, yet so powerful, that it seemed like magic. Whenever you make money, keep at least 10% for yourself. Tom thought, hey, I always save for the rent, for the electricity bill, for the credit card, but I never saved the same for myself. So he decided to test it. I earned $2,000 a month, I saved $200 and pretended I'd never seen that money. I hid it in a separate account like an invisible safe. At first it was tough. He had to cut back on some outings, swap expensive coffee for homemade coffee, and learn to say no to impulse purchases. But do you know what happened after a year? He had over $5,000 saved, and it didn't even seem like that much of a sacrifice. With that money, growing, Tom began to study investing. Nothing too risky at first. He wanted to learn the ropes before jumping in for real. That's when he discovered a magic word: dividends. He discovered that some companies pay a portion of their profits directly to those who own a share. Something like this. He would buy a little piece of the company, and from time to time, he would receive a share of the profits without doing anything else. Hey, so my money can work for me? Yes, exactly that. Tom started choosing companies that paid good dividends, reliable, solid. He reinvested the money that fell through, like a plant that bore fruit, and he used that fruit to plant more. Of course, not everything was perfect. He saw some ads on YouTube saying he could double his money in a week. He believed it. He put almost everything into shares of unknown companies and lost more than half. It was a shock, but he learned something he never forgot. Investment is not a casino, it's patience. After that, he became smarter. Only solid companies, reliable funds, long-term focus, and always paying attention to dividends as extra income. Result? In 2 years, he went from $0 to $20,000, with calm, focus, and a change of mindset. Step 2, from $20,000 to $100,000, your money starts working for you. When Tom hit the $20,000 kept, he realized one important thing. His money was starting to work harder than he did. Remember the dividends? That money that came into his account just because he owned shares? Now those dividends were getting more interesting. Before, it was a few cents a month. Now, with $20,000 invested in good companies, he could already see it falling $40, sometimes $70 per month without lifting a finger. It wasn't much, but it was a real beginning. And most importantly, it was automatic. Tom understood that this was the secret of the rich people he saw in videos and books. They weren't always trading time for money. They created systems that generated money all the time. So he created a new goal. I want to reach $100,000 as quickly as possible, but without losing my mind. And that's when he did 3 things that changed the game. 1. Increase income. He realized that saving money only took him so far. So he started selling things he no longer used, an old camera, a broken bicycle, even books. Then he learned online skills, video editing, basic marketing, and started taking on freelance work on the weekends. The extra money, everything went towards investment. 2. Reinvest. All dividends, that money that came as a bonus. He never spent it. I would buy more shares with her. It was like planting a seed, reaping the fruits, and instead of eating the fruits, planting again. It's like playing a game where each victory gives you more pieces to play better. 3. Avoid traps. Tom almost fell for magical opportunities again. Crypto hotness, NFT schemes, sports betting disguised as investments. But this time, he took a deep breath, reread his plan, and stood firm. A good investment is one that grows slowly and steadily. Dividends, companies with solid track records, real estate funds, not sexy, but effective. 2 years later, with discipline and consistency, the long-awaited day arrived. He opened the brokerage app and saw 101,372.45 eyes. It was one of those moments where he almost cried on the subway. He had not only gathered $100,000, how did you do that in an intelligent and sustainable way? And the best part, dividends were now over $200 per month. Real money coming in without him working extra. Step 3, from 100K to 1M. The game really changes here. When Tom arrived in $100,000 invested, something changed inside him. Before, he saved because needed. Now he invested because I knew where this was going. And here's a truth that few people talk about. Getting to the first 100K is the hardest part. After that, the money starts working for you. The magic happens because of the compound interest. And also because of something Tom started seeing more frequently on his account. Dividends. Do you know those payments that companies make to their partners? So it is. Before, it was a small amount, enough to order a pizza at the end of the month. But now, dividends were starting to really pay the bills. $150, $200, $300 a month. And he didn't even need to get up from his chair for that to happen. But here comes the danger. The more money you save, the more people come up with miraculous ideas. Tom listened directly. Dude, invest in this and it will double in 2 months. Throw that money into a new business that's booming. But he remembered one thing. Those who chase easy money usually lose it quickly. So he followed what was already working. First, keep it simple, nothing complicated. He continued to invest in stocks of solid companies that paid dividends every month. Real estate funds, ETFs that grew slowly but surely. Second, adjusted your lifestyle. Intelligently, he started to live a little better, yes. He went on a trip, bought a good used car, but no ostentation. The focus was still freedom, no appearance. Third, automated everything. As soon as the salary dropped, part of it went directly to investments, every month, without fail, as if it were a bill to pay, the account of his future. What about dividends? Now they were coming in with force. $700, $900, $1,200 a month. It was enough to pay the rent, the supermarket, and still have some left over. 5 years later, on any given morning, he looked at his phone, opened the app, and there it was. $1,021,000. It wasn't luck. It wasn't a lucky break in cryptocurrency. It was consistent, it was focused, it was believing, and the best part, even if I don't work anymore, the money keeps coming in. He was no longer chasing money. Now it was the money who ran after him. He was booked. Step 4, total financial freedom. When money stops being a problem, Tom didn't know exactly when it happened. But one day, he woke up, looked at his account, and saw the dividends falling, and he realized, I will never have to work for money again. It wasn't about being rich in the traditional sense. He didn't have a private jet or a mansion in Malibu, but there was something that most people will never have. Time, peace, choice. He could decide how to live his days. If you wanted to work, that would be fine. If you wanted to take a whole month to travel with your family, that would be fine too. Freedom didn't come from a big jackpot. It came from a simple strategy, repeated long enough. And of course, the dividends, which now paid for almost everything: the house, the car, the hobbies, even the Christmas presents. Tom became the weird one in the class, while the friends lived exhausted, saying, "Another Monday. Here we go." Tom started the week by choosing what he wanted to do. Nobody understood very well. They thought he had inherited a fortune, but he knew the only thing he inherited was the courage to think differently. And here is the most beautiful part of this story. Tom started teaching other people. He showed his brother, who was always in debt, how to get out of the hole. She helped a friend who earned little to build a dividend portfolio. And do you know what he listened to most afterwards? "Why didn't anyone teach me this before?" The truth is that the world was made for your work, all my life, without stopping to think. But if you stop, if you learn, if you apply, the game changes. So if today you are still at the beginning, that's okay. Tom's journey also started with $100 a month, but look what it turned into. Money is not the end. Money is the quiet. The end is freedom. Imagine that you no longer have to wake up early to go to work every day. And yet, the money continues to come into your account, month after month. This is what many people here in the United States call FIRE, which means financial independence, retire early. In Portuguese, financial independence and early retirement. But calm down, it's not magic, it's a plan. There are people here who decide to save heavily for a few years. Instead of spending everything on a new car, designer clothes, and a bunch of stuff that loses value quickly, they choose to invest. They buy shares in good companies, real estate funds, the famous REITs, and even bonds that pay dividends. That is, they pay a small portion of the company's profits directly to you. The idea is simple. You work hard for a while, but you put that money to work for you until the day comes when dividends and passive income cover all your bills. Then you are free. You can keep working if you want, or not. You can travel, spend more time with your family, start your own business, or just live in peace. It's like building a money machine that never stops working, even when you take a vacation. Another important aspect of FIRE is controlling your spending. And this is where many people stumble. There's no point in earning a lot if the money disappears quickly, right? The secret is to spend less than you earn, save the difference, and invest that amount. In the US, there's a simple rule to help with this, the 50-30-20 rule. This means that 50% of your money goes toward what you need, like rent, food, and bills. The remaining 30% can go toward what you want, like going out, hobbies, or that trip. And the final 20%, that's for saving and investing. This is where investing in dividend-paying stocks, bonds, or REITs comes in. This discipline helps accelerate your path to financial independence because the more you can save and invest, the faster your dividends and passive income start to grow. Now, let's talk about investing wisely. In the US, a lot of people invest in stocks that pay dividends. It's like getting an allowance just for owning a piece of that company. These dividends are a portion of the profits that the company distributes to its shareholders. The cool thing is that if you reinvest these dividends, they help you buy more shares, and this makes your money grow exponentially over time. In addition to stocks, another good option is real estate investment trusts or REITs, which work as if you owned a piece of several rental properties. These funds also pay dividends, which helps increase your passive income. The key here is to diversify, not put all your money into one stock or fund, to reduce risk. This makes your investment safer and more stable, accelerating your financial independence. Another important point is to use tax-advantaged retirement accounts, such as 401ks and IRAs. These plans are super smart ways to invest because the government gives you perks, like deferring taxes or even avoiding some taxes, which help your money grow more. With a 401k, your employer often contributes, which is like free money toward your retirement. An IRA is an account that you open yourself, and can choose how to invest, whether it's in stocks, mutual funds, or even government bonds. Starting to invest in these accounts as soon as possible makes a huge difference because time allows your investments to grow significantly due to compound interest. The sooner you put money there, the bigger your balance will be in the future. Index funds are a super practical way to invest because you buy a slice of a fund that has several stocks together, like a basket with many different fruits. Instead of choosing just one company, you invest in many at the same time, which reduces the risk of losing money if one of them doesn't do well. One of the most popular index funds is the one that tracks the S&P 500, which includes the 500 largest companies in the US. This means that your money is invested in giant companies like Apple, Microsoft, and Amazon, solid companies that have a high chance of growing over the long term. Additionally, these funds usually have very low management fees, which helps you keep more of your money invested. Unlike actively managed funds, which try to guess what will go up and end up charging higher fees, index funds simply follow the market without trying to make picks. Another important point, many of the companies that are part of the fund pay dividends. Dividends are the money that the company distributes to shareholders as a reward for having invested in it. This money can be withdrawn for you to use, or better yet, it can be reinvested to buy more shares and increase your investment, creating a snowball effect on your assets. So in short, investing in index funds is a simple, safe, and cost-effective way to put your money to work, with a good chance of growth over the years and still receiving dividends to boost your gains. Another investment that works really well in the US is the ETF, which stands for Exchange Traded Fund. Think of an ETF as an index fund, but with an extra advantage. It is traded on the stock exchange, just like a stock. This means that you can buy and sell ETFs during the day, during market hours, with ease. ETFs also track indexes, such as the S&P 500, but there are many different types. Some focused on technology, others on healthcare, energy, and even companies that pay good dividends. So, you can choose the one that best suits your goals. One cool thing about ETFs is that, because they are traded on the stock exchange, they are very liquid, meaning you can quickly turn your investment into cash whenever you need it. And the fees are usually low too, because management is passive, just tracking the index. Additionally, some ETFs focus on stocks that pay high dividends. This is great for those who want to earn a regular income because the dividends go straight into your account and can be reinvested to further grow your portfolio. Investing in ETFs is a practical, flexible, and efficient way to diversify your money, taking advantage of the gains of the biggest companies and receiving dividends along the way. Now let's talk about REITs, which are real estate investment trusts, funds that invest in real estate. In the United States, REITs are super popular because you can invest in real estate without having to buy a house or an entire building. The cool thing about REITs is that they pay dividends regularly because they have to distribute at least 90% of their profits to investors. This means that in addition to the share price increasing, you receive passive income every month or quarter. REITs can invest in a variety of real estate types: shopping malls, office buildings, logistics warehouses, hospitals, and even cell towers. And because these sectors have different demands, diversification helps protect your investment. What about liquidity? Unlike buying a property directly, with REITs you can buy and sell your shares on the stock exchange easily without bureaucracy. Investing in REITs is a great way to build a portfolio with passive income through dividends, taking advantage of the US real estate market in a practical way. Another smart way to build passive income is through dividend ETFs. ETFs are funds that combine a bunch of stocks into one box. When you buy a share of an ETF, you are investing in several companies at once. Dividend-focused ETFs select companies that pay good dividends on a regular basis, so you get a small piece of their profits without having to pick and choose each share. It's very practical. Because the ETF takes care of the management, and you can still diversify your money across different sectors, such as technology, healthcare, finance, all at the same time. And best of all, many ETFs pay you dividends too, creating another source of passive income. This helps your money grow steadily. Now, let's talk about REITs, which are a very popular way in the US to make money from real estate without having to buy a house or apartment. REIT stands for Real Estate Investment Trust. It is a fund that invests in real estate, such as commercial buildings, shopping centers, or even hospitals. When you buy a share of a REIT, you are investing in those properties, and in return, you receive a share of the rents they earn. It's like owning a piece of that building. REITs tend to pay high dividends because they are required by law to distribute at least 90% of their profits to investors. This makes them a great option for those looking for a steady passive income. Plus, REITs are publicly traded, so you can buy and sell them easily, just like a stock. Now, let's talk about index funds, or ETFs, exchange-traded funds. They're like a basket of stocks or bonds that you buy all at once. For example, an ETF can have shares of the largest US companies, such as Apple, Amazon, Google, all together. This way, you don't have to choose just one stock and you are protected if one of them falls. The cool thing about ETFs is that they have low fees, and you can still earn dividends because the companies within the fund pay them out to shareholders. Buying an ETF is like buying a piece of several companies at once, with less risk and without the hassle. This helps diversify your money, which is a fancy way of saying not putting all your eggs in one basket. Now let's talk about fixed income, which is different from stocks and ETFs. Fixed income investments are investments that work like a loan you make to the government or companies. They promise to pay you back with interest within an agreed period. Here in the US, common examples are treasury bonds, which are very safe, and corporate bonds, which generally pay more interest but carry a little more risk. The thing about fixed income is that you know how much you're going to receive, or at least have an idea, unlike stocks that can go up or down. Additionally, some bonds pay interest periodically, almost like receiving dividends, except that it is the payment of interest on that loan. It is a more stable way to invest, especially if you want to protect your money and still earn an income. Investing is a smart way to make your money grow over time. Whether you choose dividend-paying stocks, ETFs for diversification, or fixed income for safety, the important thing is to start slowly, learn, and stay focused on the long term. This way, you can build a solid foundation for your financial future while taking advantage of the benefits of the US market.